Brad Williams, Frugal Finance, hedging with stock index futures. This is going to be a repeat for the most part. We're going to cover a few new topics, but in short, the practice is going to be similar. That being said, previously we considered the basic technique for hedging with stock index futures. We presented examples of short and long hedges and discussed hedging strategy for hedging a portfolio with stock index futures that reflected the beta of the portfolio being hedged. The minimum hedge ratio, where we were looking at variance and covariance. Reread this. Minimum risk hedging example in this section. We will look at an example of minimum risk hedge in a stock index future using market data. If you need to go back over, and if you don't understand CAPM, take a look at my valuation session. That'll be towards the end. I think it's number 18 or 19. And then the series there, we have valuation and return on equity, a couple other. It's the last four. And I talk about CAPM. If not, that's just basic finance. If you need a list of books, just let me know. And I could recommend a few. Just give you an overview of CAPM. Otherwise, the risk minimum hedging example. In this section, we'll look at an example of a minimum risk hedge stock using market data. Let's assume that a trader has a portfolio worth $10 million on November 28th. The portfolio is invested in the 30 stocks in the Dow Jones Industrial Average. The portfolio manager will hedge this cash market portfolio using the S&P 500 June futures contract. We look at each step the investment manager follows, compute the hedge ratio, and to execute the hedge. Organize data and compute returns. The manager plans to hedge according to equation 7.6. Therefore, she needs to find the beta for the hedge ratio. Accordingly, she collects data for her portfolio value for 101 days from July 6th through yesterday. She also finds the price of the S&P 500 June futures for each day. There's nothing magical about using 101 days, but this data is available. And she believes that the proceeds will provide a sufficient sample to estimate the hedge beta. For the 101 days of prices, she computes the daily percentage change in the value of the cash market portfolio and the future prices. This gives 100 paired observations of daily returns. This is just a normal practice in terms of calculating beta. Estimating hedging beta with the data in place, the portfolio manager regresses the cash market returns on the returns from the futures contract as shown in equation 8.1. So SFT is equal to this. From this regression, the estimated beta is 0.8801. So beta R of M is 881. This indicates that each dollar of the cash market position should be hedged with 0.8801 in the futures position. The R squared from the regression is 0.9263, which is outrageous. That means they're highly correlated, is what they say. And this R squared encourages the belief that the hedge is likely to perform well. Again, for emphasis, the estimated beta from regressing the portfolio's return of the stock index future return is not the same as the portfolio CAPM beta. BP does not equal BRM. Keep that in mind. Compute futures position. The portfolio manager wants to hedge 10 million cash portfolio with the S&P June futures contract. After computing the risk minimizing hedge ratio, we've done this already, the investment manager needs to convert the hedge ratio to the correct number of futures that take into account the size of the future contract. On November 27th, the S&P futures closed at 354.75. The futures contract value is for the index times 250. Therefore, applying equation 7.6, she computes the number of contracts as follows. Equation 7.6, beta V of P divided by V of F. Keep in mind here, I don't like this. If you try to use this in Excel, it's going to spit out the wrong number. It's going to divide this by 354 and then times 250. To streamline this, just put parenthesis around this. Yeah, I know. There's an order. Multiplication is supposed to be first. In some instances, the division overrides the multiplication. What happens? 10,000 is divided by 354, and then that's multiplied by 250. 354 times 250, 10 million divided by this is the estimated risk minimizing futures position is negative 99. So portfolio manager has to either roll up or roll down. So she rolled up to 100 contracts. Expected hedging results, the portfolio's ending value is 9656. The portfolio, the settlement price for the futures is 3360. Therefore, the futures profit is 100. That's the number of contracts times the contract value, 250, times 354.75 minus 330 equals 603.750. The futures profit results from trading 100 contracts with each index point being worth 250 and the index having fallen 24.15 points. The value of the hedge portfolio consists of the cash market portfolio plus the futures profit. The hedge portfolio's terminal value is 10,259,840. In this example, the hedge protected the portfolio against a substantial loss. In the real world, an institution hedging with stock index futures would use the CME's S&P 500E mini contract in combination with the larger open outcry version of the contract. I doubt if that's still available. It's probably now all electronic to refine the hedge construction. Why would you use the mini? Because it's a $50 contract as opposed to $250. The S&P E-mini has the same terms as the regular S&P, except that each index point is worth 50 instead of 250. In this example, the hedge construction could be refined by selling 99 regular S&P 500 futures and one S&P 500 E-mini futures contract. Ex-ante versus ex-post hedge ratio, that's pure academia. Just kind of shrug it off. This is somewhat academic, but also practical. Trying to put in some practical examples so you can hit the ground going, all right, I kind of get it. You know, our risk minimizing hedging example, we computed BRM, that's beta of the index, using historical data and applied the hedge ratio to future period. It is unlikely that the estimated hedge ratio would equal the hedge ratio that would have used if we had a perfect foresight about the behavior of the cash market position in the futures position. This is the difference between an ex-ante and an ex-post hedge ratio. Ex-ante, or before the fact, the best hedge ratio we could find was negative 0.8801. Ex-post, or after the fact, some other hedge ratio will be likely to perform better than the ex-ante hedge ratio of 0.8801. That wasn't negative 881, that's just 881. In this section, we consider the difference between ex-ante and ex-post hedge ratios in the context of our example. The portfolio manager used historical returns from July 7th to November 27th to estimate the hedge ratio of 0.8801. That's hedge ratio. I'm sorry. This one should have been negative. Hedge ratio of negative 881. Yeah, that's insignificant. She applied this hedge ratio on November 28th and maintained the hedge position until February 22nd of the next year. The ex-post risk minimizing hedge ratio was not available to her when she made her hedging decision on November 28th. What would have been the ideal risk minimizing hedge ratio had she complete knowledge about how prices would move from November 28th to February 22nd? To find this ex-post hedge ratio, we estimated equation 8.1. Here we go. S&T, and then this formula using data from November to February and found this ex-post hedge ratio of negative 9.154. This implies a futures position of 51.61 contracts. We round this to 52. Figure 8.3 shows the results of hedging with the ex-ante and ex-post hedge ratio. Well, it's going to show you better results. In a real world, the ex-post hedge ratio is the risk minimizing hedge ratio that we would like to see. However, the ex-ante hedge ratio is the best estimate we can make at the time the decision must be implemented. Figure 8.3 shows the ex-ante ratio performs quite well. The terminal value of the hedge with the ex-ante hedge ratio is 10,259,840. With the ex-post hedge ratio, the terminal value is 10,283,99. While the ex-ante hedge performed well, the ex-post hedge would have been even better. You know, nothing like Monday morning quarterbacking. Yeah, we can always say ifs and buts brought candy and nuts, we'd all have a Merry Christmas. But going back and saying, well, this could have been. Well, of course it could have been. What you have to do is determine why, and we're not going to do it right now. You need to determine how to fine-tune that hedge ratio. That's the secret. Again, it's just simple mathematics, and I'm sure I'm going to show you probably some ways to do that. Brad Williams, Frugal Finance. See you soon.